discount houses, rates were little changed at 14.6% for the banks and 14.3% for discount houses. Well, today we're looking at multiple time frame analysis from the currencies market. Joining me now is Michael Akinwale, who's going to tell us what all of that means. Good morning, Michael. Thank you so much for being here. But before we start with what we're looking at today, let's look at a general overview of what the markets were like last week, particularly the currencies. What was that currency or currencies pair that rallied last week?
Basically, if you focus on the major pair, which is the euro-US dollars, there was a very big rally on Friday that gave a lot of profit or gain to the euro, and that was basically driven by the consumer price index, which was released a little bit negative for the US dollars, and I think that is actually a lot of concern right now for the US dollars, because the major factor that drove that negative was the price of oil. With the increase of the price of oil, is affecting production in the US, and with that affecting production, is affecting what the factories are able to chunk out, and eventually affecting consumer price index. So basically, the US dollar is at a point now where they don't need the value of oil to go up, basically. So that's what we're looking for this week. There's a particular principle that's supposed to come out from the New York Federal Reserve. If there is a statement that is made, and traders find it favorable and they see that okay, there's going to be a strengthening in the US dollar, because basically the dollar has been strong, against the euro, except on Friday where the euro took quite some of profits back from the US dollars. But
there seems to be some kind of stability, especially at the European market. Things are a little bit quiet right now from the policy makers front. We have the whole Greece thing settled now, so the markets are now
settled, but not yet in effect. They settled it, but it's going to take time for the economy to pick up. So investors don't really find the sentiment had effect at that time, but until it picks up and the economy begins to respond to whatever decision they made, that's when we actually begin to see that effect on the euro.
Okay, so for last week, those currency, what about the dollar? The dollar fell on its own, but as a pair with the euro?
On its own, actually, was weak. It was weak on Friday, thereabout.
But with the pair, the euro-USD pair, that strengthened?
That's strengthened, yes.
Okay.
That means the euro was strong and the dollar was a little bit weak.
Okay, okay, that's what that means. What we're looking at today, more with the basics.
If you actually been following this currencies analyst program, you will discover that we talk a lot about time frames. We want to talk about candlesticks, we talk about time frames. Let me try and break it down to what a time frame is. If we travel kilometers, 10 kilometers. If I break it down into, let's say, 1 kilometer, you're going to have 50 one chunks. So basically, a time frame is the fact that this is a 24-hour period between today and the same time tomorrow. It's a 24-hour period. As price is changing, there's the opening price, the closing price, the highest price, and the lowest price in that time period. As that is happening, the market keeps moving and moving and moving, and as it's moving with time. So the time frame is basically how long you're looking at in the market. So if you're looking at the 1 minute time frame, for instance, that means you're looking at the opening, the closing price of every 1 minute. If you're looking at a 4-hour time frame, that means you're looking at the opening and the closing price of every hour. Before, when the currencies market and all these markets started, all we had was daily time frames, because you didn't have access to what's happening per minute, per hour. So basically, a time frame is basically how long of the price you're looking at in the market.
Okay, so in applying that to analysis, how exactly does that affect analysis or the view of the market?
Now, you see, when like I was talking about the distance thing, if I'm to plot using the 10 kilometer thing, that means I'm going to have just 10 blocks to plot between Lagos and Ibadan. That means 10 kilometers, 10 kilometers, 10 kilometers, 10 kilometers. If I'm going to reach 1 kilometer, you're going to be looking at 1 kilometer, you're going to have 50 blocks. So the bigger the time frame you're looking at, the less the blocks you see. And the smaller the time frame you're looking at, the more the blocks you see. But when you're looking at a lot of blocks, it takes a lot of space to fill in those blocks. So basically what happens is that when the trader is looking at the smaller time frames, he can only see a short distance because it takes more blocks. So he can only see a small distance. So what this does is that for traders who trade short term, they use smaller time frames. For traders who trade long term, they use bigger time frames, because on the bigger time frame you can see a bigger distance, in the market movement basically. So that's basically the way it affects traders. If you look at it, if you're using a weekly or daily chart, you'll be looking at long term time frames. If you're using maybe 1 hour to 4 hour time frames, you're looking at medium terms. And if you're looking at 1 minute, 15 minutes time frames, you're looking at very short time frames. So like I was talking that time, we were talking about the types of traders. Scalpers use 1 minute charts, 5 minute charts.
Because they're only there for a few minutes?
Few minutes,
okay.
Scalpers. Swing long-term traders use their daily charts, weekly charts, because they're looking at a long-term period of the market. So basically, that's where time frame comes into play, in analyzing the market.
So how important is it? Is it something that a trader must have or must use, or are there alternatives? Is it something that is it compulsory?
With the way the market is built in, because it's like the, I won't say the heartbeat, but it's like the way you're able to perceive what the market wants to do, because it's time. If you check the graph we use in trading, it's just a graph of time against price. So what the time frame does for you is that it helps you to see what the market, you use it to analyze the market. So for you to analyze that market effectively on a specific time frame, you must actually be looking at what price is doing on that time frame. So what we want to look at on this time frame analysis is that a trader cannot afford to look at just one time frame. Because the terrible thing about that is that when you're looking at just one time frame, you are stuck on that time frame, and price could be showing you that it's going down on this time frame, whereas it's doing something else on another time frame.
But I thought you said if, like for the scalpers, if they're on a short time frame, they need to use just one or short time frame. So if that's all he's doing, shouldn't that be all he should be focusing on?
Yeah, but at the same time, for instance, on the long time frame, the price could actually have a big downtrend. That means if I'm a scalper and when the price is on a downtrend and I am selling, that means I am expecting the price to go down and it's on an uptrend, I have to be very careful. You must have that insight anytime you are trading of the overall, long-term trend. If you are not actually a long-term trader, even though you are trading short-term, you should have an idea of what's happening on the long-term frame. Okay,
while a trader should keep his eyes on what other time frames, how can a trader implement